Could Australia's unemployment rate really get to 9%? Well, that's one of the warnings Reserve Bank Governor Phillip Lowe gave our Parliament when he was talking to them last week about how his main aim at the moment is to get inflation under control. This week, Dr Andrew Wilson and I discussed this, what's happening to employment and what's happening to inflation around the world. So if you want to keep up to date with what's happening in our markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you informed each time a new show comes out. Reserve Bank Governor Phillip Lowe can't stay out of the news, can he? Last week he was grilled by the Senate as well as the House Standing Committee on Economics. In his statement he emphasised that getting inflation down was his priority right now and that we should expect a number of further interest rate rises. Yet despite the Reserve Bank delivering another rate rise this month, and there's indications of more to come, and that was again amplified this week by his hawkish language in his parliamentary testimony, the residential property markets around Australia, they haven't weakened, have they? House price declines continue to level out and auction clearance rates are higher, despite all the consumer sentiment polls telling us we're really in the dumps. Now, the latest unemployment figures are interesting, particularly in light of Dr Lowe telling MPs that the unemployment rate may go as high as 9% to crush inflation. But that would, of course, only happen if inflation became entrenched, but boy, would that create a recession. I'm looking forward to unpacking these latest figures and discussions and what's happening to inflation around the world with Dr Andrew Wilson, Australia's leading housing economist. Hi, Andrew.
Yeah, good day, Michael. It's quite amazing, isn't it, that the Reserve Bank Governor is back in the news again. He's certainly been the focus, particularly of a lot of criticism for his recent announcements and, I guess, policy positions. Now it's happened again, and I'm not sure what the future lies in terms of the structure of our Reserve Bank board going forward. And certainly there are serious questions now being asked, but just even mentioning that 9% unemployment rate, which would be, let me be very clear, a disaster for the country. If we did have a 9% unemployment rate, and we're not saying the Reserve Bank Governor said that that was their target or it was going to happen, but the very fact that he said that maybe to control inflation we need to get as high as a 9% unemployment rate really puts that number out there. But if I could remind everybody, the last time we had an unemployment rate that high was in the early 90s, when our unemployment rate just moved over 10% as a result of that infamous early 90s recession. And of course, focusing on MPs, and that was where he made his statement to, I think governments don't last long in recessionary environments. And if we do remember back to 1991, we had what we had then was a long-term walk Keating government, and if it wasn't for the disaster of Fight Back and John Hewson, they would have been kicked out of government quick smart, but they survived one more term and then they were kicked out big time, and that let the opposition in for more than a decade of government. So that's the political result of very high unemployment. And of course, the real result is the disaster that it has on lives and livelihoods. That 1990 recession really took a decade to wash its way through the system. And there were some really tragic stories about the consequences of people being pushed out of work through monetary policy. And I think we can do better, surely, Michael, this time around. And I'm quite horrified to think that there'd be even speculation of unemployment rising to those terrible levels.
What he was saying, of course, was if we don't get inflation under control now, he may have to raise interest rates that high to create that level of unemployment. But interest rates didn't work a while ago when he was trying to get inflation up from those low levels to their target band of between 2 and 3%. Andrew, are they going to work on the other side when they're trying to get it down?
Well, it's not working, Mike. Hello. Again, it's not working. If we look back, as you mentioned, to the pre-COVID environment, we had low inflation, low economic growth, and relatively higher unemployment, and we couldn't fix it, and we kept cutting rates. Now, the Reserve Bank at that time kept rates too high for too long. I was a critic at the time along those lines, and then they desperately chopped interest rates when they realised that they had got it wrong through the back half of 2019. Now, it looks like a repeat performance of that, but let's hope they're not going to be desperately raising interest rates because they realise they can't get inflation under control. And there's no sign yet that it's under control, Michael. our inflation rate is higher than the US. A lot of that, of course, is because of high building costs. We're in a better position in terms of our wages growth levels. They're nowhere near what the US wages growth levels are, and that's certainly fueling inflation in the US. But we do get the wages data out this week, Michael, for the December quarter. So it'll be interesting to see how that's working at the moment. And I suggest we will see a surge in wages over the December quarter, not anywhere near the US or the UK levels. You know, as we saw with that latest inflation data, service prices are now starting to rise. And that's the first indication of moving into that wages prices type of relationship. We haven't got inflation under control yet. No sign of that whatsoever. We will have to face, unfortunately, the spectre of rising energy costs, particularly electricity, which have got nothing to do with anything else but the transition out of the carbon economy. That's something we're going to have to live with. And of course, higher electricity costs will work their way right through the food chain, generally for higher costs. So we've got to live with that. So if the governor's saying, well, we've just got to get rid of this high inflation, even if it's caused by extraneous type of circumstances, then, and if we have to get high unemployment, so be it. That's you read between the lines. And there's no doubt that those headlines will resonate in the media. And even if it was said just as a speculative statement, nonetheless, it certainly has bite. But at the end of the day, it's a terrible outlook if that's where we're heading. And I think we've got to figure out other ways of doing it. Monetary policy has failed really over the last decade to achieve the results which they were supposed to. And really economists are looking pretty silly at the moment, Michael.
Well, you mentioned the United States and the United Kingdom. Inflation's eased in the United States for the 7th month in a row in January, helped by lower costs. But similarly, in the United Kingdom, inflation fell for the 3rd consecutive month in January. And that eased pressure on both their central banks to raise interest rates.
Yeah, that was the big headline was, inflation's eased in the UK, and UK media was screaming that, this means that we won't get any more increases in interest rates. It's over 10%, Michael. Inflation in the UK is tracking over 10%. It came down a couple of points, whatever. We and the US are in the sixes. The point is, of course, the UK wages are growing significantly, up around 7% at the moment, which is significantly higher than Australia, which is still at around about 3.1%. Well, that was the September quarter data. So I wouldn't be calling it an end game yet in terms of the UK's position. And the US are probably a little bit better position, but again, their wages are still rising strongly, and their labour market is strengthening, Michael, which we'll look at in a minute. Is a little different to what we're seeing in Australia now. This is now evolving, and I hate to think that our central banks and Australia's central bank, Reserve Bank board, it's just got their head in dusty old textbooks, which are consistently irrelevant now.
Well, we were talking about labour. The January figures came out and headline unemployment declined 11,500 and the employment rate rose just a little bit to 3.7 and the participation rate just fell a fraction to 66.5. But Andrew, around January, a lot of people put off taking jobs. They take annual leave. They wait until they start new jobs till after the holiday period. So what is your take on what those January unemployment figures were?
Well, Michael, I think that it's really confirming what we said a month ago with the December numbers, that just a little bit of a hint that we'd reached the peak of our current labour market strong cycle. Yes, the January jobless did increase to 3.7%. Let's remember, however, these are seasonally adjusted figures, so they're supposed to take into account the obviously quieter period that January is, so up to 3.7%. That's actually the highest result since May last year, Michael. So when we look at that, we're certainly now moving ahead of our low points in the second half of last year. We also saw a fall again in employment. Employment was down by 11,000 jobs. Now, it also fell over December, and that's the first consecutive fall in employment that we've had since August 2021, which of course was driven by lockdowns in the COVID period. So first consecutive fall in a couple of years in employment. The unemployment numbers also were up again, up by 22,000. And as you mentioned, Michael, the participation rate fell again, still quite high at 66.5%, but it is the lowest again since May 2022. I think we certainly can now be stronger in speculation that we have peaked in terms of our labour market performance. It is still a very, very strong economy. I'm amused, Michael, that you mentioned the consumer sentiment surveys, which are really, and as I said, I'm a bit of a critic of those, as you know. I think they're backward looking, and people say in those surveys what they think they should say, and then they go out and keep spending like drunken sailors, and that's what's happening. Of course, we've still got a remarkably robust economy in terms of retail sales, and now we're seeing people are out buying houses again, Michael. So I'm not sure that those sentiment surveys are on the mark, but certainly there's no doubt that we still, despite what I've just discussed there, looking like we've peaked in terms of our labour market, we still have a very, very strong economy and a very, very strong labour market, Michael. But higher interest rates and a surge in migration has to put some increasing supply and reducing the capacity for purchasing with higher rates. It has to put some stress on our labour markets, and I think we're clearly seeing it now. And at the end of the day, this will probably make the Reserve Bank happy that they can now point to early signs, consolidating early signs that interest rate policy is working. Now we have to see if it'll work on inflation.
Well, we've had lots of migrants come in already, and the suggestion is that they're not only going to have to find work, but they're going to have to find homes. But your chart here shows how the labour force has been increasing over time, Andrew.
Yes, and the reason we have such a low unemployment rate in Australia, Michael, is because of our locked borders. And if we look at the period up to COVID, compare it to the same period to now, we can see that our workforce increased by 4% over the current period, but it was up 6.3% the same period prior to COVID. And that's a difference of 267,000 workers, Michael. And that's why we've got now these chronic labour shortages and that low jobless rate. But of course, having our borders open again and a surge in migrants will bring us back to a more what we might call a normalised environment in terms of our labour market.
I just wanted to interrupt this week's Property Insider Chat to remind you that this is not specific property advice because we don't know your personal circumstances. But if, like many property investors, you're wondering what's the right thing to do at present, should you buy, should you sell, should you wait, you can trust the team at Metropole to provide you with direction, guidance and wealth-producing results. Whether you're a beginner or an experienced investor, at times like we're currently experiencing, you need an advisor who takes a holistic approach to your wealth creation, and that's exactly what you get from the multi-award-winning team at Metropole. We help our clients safely grow, protect and pass on their wealth to future generations through a range of services: strategic property advice, buyer's agency, wealth advisory, property management, renovations and development management services. Go to metropole.com.au and explore your options with a complimentary clarity consultation. Well, turning to the property markets, we regularly keep track of the auction markets, and you in particular, one of the first out with all the auction reports and very, very detailed auction reports every Saturday on LinkedIn, and also we publish those on Property Update. And the beginning of the 2023 auction season's gathering momentum. There are more properties up for sale. But despite rising interest rates, and as you said, those negative consumer sentiment surveys, it seems like buyers are out there and it's becoming more of a seller's market.
Well, these are spectacular results. Perhaps that's an overkill, calling it spectacular. But I think everybody's surprised at those Sydney results, Michael.
Yes.
75.6% clearance rate at the weekend from reasonable numbers. This wasn't a low number of auctions. Nearly 600 auctions, 75% clearance rate. I mean, we're now tracking or closing in on the levels of a year ago. And of course, a year ago, we were at just coming off what was a very strong housing market boom, price boom. I'm not suggesting that's happening now, but these clearance rates are very heady in Sydney. And of course, it's not just a one-off. Sydney's now recorded 3 weekends to start the year in a row with clearance rates over 70%. And let's remember that the Sydney market finished the year in the low 60s. So this is a significant lift from what was reported over December. We're back to looking at clearance rates around about the same level as where we were a year ago, Michael. This is just, as I said, quite remarkable, given normally we start the year off pretty close to where we finished the year off. And we've had every month since May an increase in interest rates. I think that buyers and sellers are generally shrugging off the interest rate increases and are completely ignoring all the negative sentiment in the marketplace. And they're back out. They're back out buying and selling properties. That Sydney result, quite remarkable in that context. Melbourne also lifted. It had a big number of auctions, nearly 700 auctions in Melbourne. Clearance rate of 66.7%, which again was higher than the previous weekend. Brisbane, similar strongish result for Brisbane with higher auction numbers. And of course, Adelaide, as usual, led the charge with just under 90% clearance rate. Canberra, a little softer. I think there's some local issues in that Canberra market that are just holding it back, and maybe a little bit to do with changes in the public service structure there. But that's speculating. But still a market that's come off a very strong period in Canberra. But as we know, Michael, quite clearly the Sydney and Melbourne results set the national narrative. It will be those Sydney results, particularly that where the commentary on where the housing market is focuses, and we're having a real shift from doom and gloom to boom and boom, perhaps going forward. But of course, we're only 3 weeks into the year, and we will see more auctions coming through, particularly in Melbourne as it leads up to its first Super Saturday in a couple of weekends' time. So let's hold the powder a little bit at the moment, keep it dry. But certainly these are very strong results for an early season market that was coming off a modest revival last year, Michael.
Well, there's no doubt our property markets are going to experience a lot of headwinds this year. Interest rates, inflation, the negative media. But having said that, so far they're holding up well. Buyers are confident. I guess they've taken into account, yes, interest rates are going to be up again once or twice, but they're taking that into account in their budgets and they're getting on with it. That's what we're finding on the ground. And there's a lot of investor sentiment, positive investor sentiment at the moment, Andrew.
Yeah, well, with high inflation, higher interest rates, of course, we have the positive from an investor's point of view of increased incomes because of those very tight rental markets are driving a lot of competition from tenants for available properties. Not that there are many available properties. And of course, that's positive emotion for investors and landlords to have, is that they know that there's plenty of upward pressure on rents at the moment. So that can help them offset inflation and higher interest rates. But look, the market is, I think the interesting thing about the market, Michael, is there's certainly a sense over these first 3 weekends. And as I said, it is early days, but there's certainly a sense of momentum here. It's clearly improving. And as we know, sentiment is very important in housing markets, particularly in the short term. And I think those who did sit on their hands last year when we were in the midst of the doom and gloom mantra through winter, maybe now starting to think, well, I better get in, because prices will certainly start to rise if these clearance rates at these levels, particularly in Sydney, maintain. And of course, then we move into that other sentiment mindset, which is FOMO, which is fear of missing out. So we might have a little bit of FOMO starting to appear soon, Michael.
It'll be interesting, and we'll keep track of that each week in our weekly Property Insiders chats. Thanks, Andrew.
Thanks a lot, Michael.